join us.
Good morning and hello everyone. Can you hear me okay?
Hi, Cecile.
Hello. Good morning from Bangkok. I see a lot of friendly faces on the screen. My name is Cecile Neong and I'm the practice manager for finance, competitiveness and innovation at the World Bank Group. And I'm delighted to be the moderator for this event. So I'd like to welcome you here today. This is the final day of our first Sustainable and Inclusive Finance Forum, which has gone very well so far. And today we are launching the World Bank report on Malaysia's domestic bond market, the success story. So before we start the program, I've been asked to draw your attention to several housekeeping issues so that the event can proceed smoothly. So one thing is all participants have been, microphones have been muted upon entry to this session, except for the speakers. Exactly. So we have actually a large number of attendees today. So the microphones and videos functions of participants are going to remain turned off throughout the session. Only the hosts and the presenters will remain on video to facilitate the proceedings. Now, of course, that is not to say that we don't want an interactive session. And so questions from the panelists will be taken via the chat function, which is located at the bottom right of your screens. So I hope that you can see this chat function. At the end of the session, we'd be very keen to hear your feedback. And so we'd like you to take the short poll that we've put together so that we can actually know how to improve. As I mentioned, this is the first such, finance forum for Malaysia. Now, but today I'm told that we have around 400 people registered for this event from around 25 countries. We're very pleased to have today a very distinguished group of experts in capital and bond markets and representatives who will share their thoughts and insights on this subject, including on the Malaysian domestic bond market development experience. So with no further ado, let me introduce our first two speakers. I will start with our first speaker, Datuk Syed Zaid Albar, who is the chairman of the Securities Commission Malaysia. Now, Mr. Syed Albar is unable to attend the session in person, but he has sent us a recording of his opening remarks, and we will broadcast it very shortly. But before we do that, I'd like to introduce Syed Zaid. He is the executive chairman of the Securities Commission Malaysia. Prior to his appointment as the SC chairman on November 1st, 2018, he was the managing partner of Albar and Partners. Currently, Syed Zaid chairs the Capital Market Development Fund and is a member of the board of the Financial Reporting Foundation. He was also appointed as a board member of Securities Industry Development Corporation in January 2020. Syed Zaid represents the Securities Commission as the Asia Pacific representative, on the governing board of the International Organization of Securities Commissions, IOSCO, the global body of capital market regulators. Syed Zaid has a degree in law from the United Kingdom. He is a barrister at law and has over 38 years experience in legal practice, predominantly in the fields of corporate law, capital markets, conventional banking, and Islamic finance. He's been recognized for his contribution and achievements in the legal practice through numerous domestic and international awards. With his experience in finance and law, Syed Zaid has served on the Islamic Law Review Committee of Bank Negara Malaysia and the Appeals Committee of Bursa Malaysia BHD. He's also served on the boards of several public listed companies in Malaysia. We are now going to broadcast his opening remarks.
A very good morning to you, distinguished guests, ladies and gentlemen. I would like to extend my gratitude to the World Bank Group and specifically to Dr. Firas Raad, the representative to Malaysia and country manager, for inviting me to deliver this opening remarks at the launch of your new report entitled Malaysia Domestic Bond Market, a Success Story. Malaysia's bond market is a key source of fundraising for corporates, with corporate bonds constituting USD 172 billion of total amount outstanding. This year, corporate bond issuers have raised about USD 15 billion so far. As highlighted by the World Bank's report, the bond market has successfully funded the nation's infrastructure development, which includes our highways, airports, and other key utilities. Our progress as a nation certainly owes much to the availability of a well-developed bond market infrastructure and a supportive ecosystem of intermediaries, service providers, and of course, investors. From an investment perspective, ringgit bonds are a proven asset class, given the country's strong macroeconomic fundamentals, and with more than 90% of rated issues AAA and AA, it is attractive for a deep and well-diversified institutional investor base. Islamic bonds, or Sukuk, have been the country's niche in global bond markets. Almost half of global Sukuk originates from Malaysia. Following the first issuance by Shell in 1989, Sukuk presently amounts to 80% of the corporate bond market. There have been more than 150 unique Sukuk issuers, and its appeal is widespread, being well accepted by both the Islamic and conventional investors. And based on our track record, Malaysia provides a valuable blueprint for emerging economies on developing a successful local currency bond market. This did not happen overnight, of course. It was the result of a well-thought sequential development of the market. While the report has highlighted a number of catalysts for the development of the Malaysian bond market, allow me to share two critical ingredients for its success. First is the overriding aspiration to ensure a more resilient and diversified financial system, and second, the role of regulation. Looking back, the swiftness and severity of the Asian financial crisis in 1997 took regional policymakers by surprise and had a significant negative impact on Malaysia's corporate sector. It also laid bare how fragile our financial system was. Then, the majority of corporate credit was provided through bank loans, which amplified concentration risks within the banking sector. Corporates also relied heavily on short-term borrowings in foreign currencies for their longer-term projects that had ringgit cash flows. In short, this created a maturity and currency mismatches, which led to the massive restructuring within the local corporate sector post the Asian financial crisis. This was certainly a rude awakening, wake-up call for domestic policymakers. We needed to reduce the risks that had built up and ensure the systemic stability of our financial and capital market. A key area identified for improvement was our then relatively underdeveloped bond market, regulatory framework, and market infrastructure. Market development had suffered from the lack of benchmark yield curves and a well-developed clearing and settlement system, to facilitate delivery versus payments. Therefore, we had to undertake clear and concrete efforts to promote a well-functioning bond market. This was essential to improve diversification within the financial system. In the year 2000, the Securities Commission Malaysia was designated the sole regulatory authority for the development and supervision of the corporate bond market. This dual role for a market regulator is crucial, particularly in the context of an emerging market. The SE's mandate ensured that the Malaysian corporate bond market benefited from a structured, sequenced development and planning, ensuring its growth and success. A facilitative regulatory framework coupled with clear guidelines not only ensures parameters are set for product issuances and disclosure standards, but also provide direction to market participants. I would like to describe this as akin to setting the tone from the top, while the market follows through with a similar beat and tune. The release of the revised guidelines on the offerings of private debt securities in 2003 signified the shift from a merit-based regime to a disclosure-based approach for bond fundraising. The SE strives continuously to enhance their existing regulatory framework and its processes. For example, in recognizing increased investor sophistication and market maturity, we introduced the Launch and Launch Framework, or LOLA, in 2015. This allowed for the immediate launch of the wholesale product offerings, including bonds, to institutional investors. LOLA has led to better processes efficiency, with time to market substantially reduced. And the shift in global liquidity away from the emerging market early this year highlight the conundrum faced by the developing economies. Even as local currency bond market reduce currency mismatches, they are still vulnerable to foreign outflows and the tightening of financial conditions. This begs the question, what more can be done to ensure the resilience and stability of emerging bond markets? This resiliency will likely require the following attributes. First, sound macroeconomic policies that favor the longer term. Second, an efficient support system in terms of legal framework and risk structure that promote innovation. And third, a deep domestic investor base. These three suggested attributes provide the scope to enhance the structure of the emerging bond market, including Malaysia's. While Malaysia saw minimal foreign outflows early this year, with foreign holding in bonds declining from $47 billion in February to $43 billion in April 2020, we continue to seek opportunities to deepen market liquidity. The presence of dedicated local bond fund managers may help draw more specialized talent and expertise to the local market. Presently, besides domestic corporations, we have also seen foreign issuers from Asia, Europe, and the Middle East, as well as multilateral institutions, tap the local bond market for their financing needs. We must continue with efforts to enhance the diversity of issuer type and issuance sizes within the Malaysian corporate bond market. Moving forward, we believe demand for market-based instruments that provide both financial as well as social returns will grow. As the world deals with pandemic-induced challenges, there is growing recognition that businesses have a larger responsibility to mitigate environmental, social, and governance risk. And in recent dialogues held with industry, our market participants have also shared that investors are increasingly drawn towards investments that are sustainable and responsible. The SE is committed to facilitate the growth of sustainable and responsible investments through our SRI roadmap for the Malaysian capital market, and this includes encouraging more issuances of green, social, and sustainability bonds and sukuk. Another focus area would be products and processes that can benefit from a lighter touch approach. For example, we granted flexibility this year to businesses issuing convertible notes to venture capital and private equity firms registered with the SC. And by allowing them to launch issuances with the SC directly without using a principal advisor, it enhances the cost effectiveness of the fundraising process for small, medium-sized enterprises, or SMEs. Over time, we hope that this will help widen the spectrum of issuers as well. We also want to make sure that the overall market ecosystem remains supportive, and this includes ensuring adequate and effective hedging tools are in place, as well as identifying areas and processes that can benefit from the greater use of technology. And before I conclude, I hope I have managed to put forward a strong argument in the value of building a local currency bond market, especially for emerging markets. It is particularly vital for the continued strength and resilience of the overall financial system. While the market has grown from strength to strength, both the SC and the market participant realize that our journey is not yet complete. The bond market must continue to grow and innovate, moving forward for the current and future benefit of the nation and the wider region. As we enter a new decade, the SC remains fully committed to ensuring the continued relevance and attractiveness of the Malaysian corporate bond market. Thank you.
Thank you, Datuk Syed, for your insightful comments on the capital markets and the latest developments in Malaysia. For our next speaker, it is my pleasure to introduce Alfonso Garcia Mora, who is the Vice President for Asia and Pacific of the International Finance Corporation. Welcome, Alfonso. A little bit about Mr. Garcia Mora. He is responsible for all IFC operations in the region, including operationalizing IFC's COVID-19 crisis response, building a strong upstream pipeline rooted in country strategies, and fostering more collaboration opportunities with a range of key stakeholders for broader impact. He was previously the Global Director for the Finance, Competitiveness and Innovation Local Practice at the World Bank Group. He led the World Bank's work on financial stability and integrity, financial infrastructure, inclusion and access, long-term finance and capital markets, and crisis and disaster risk finance across all regions. Prior to that, since joining the World Bank Group in January 2013, Mr. Garcia Mora has led various responsibilities in Latin America, Middle East and North Africa, Eastern Europe, and Central Asia, advising governments, supervisors, and regulators on work related to financial sector development. Mr. Garcia Mora managed the Financial Sector Assessment Program in the World Bank, leading several assessments and represented the World Bank Group in various committees of the Financial Stability Board and other standard-setting bodies. Before his World Bank Group career, Mr. Garcia Mora worked in the private sector for over 12 years including as partner managing director at Analistas Financieros Internacionales Consulting Group. Mr. Garcia Mora holds a PhD in economics from Universidad Autónoma de Madrid and served as a visiting PhD student at Boston University. He also holds a Master of Finance from the Catholic University of Leuven. Mr. Garcia Mora has lectured and published extensively on banking and financial sector issues. The floor is yours, Alfonso.
Thank you, Cecile. Thank you very much, colleagues. Good morning in Asia, good afternoon, good evening, wherever you are. These days, we don't really know where we are connecting from, but good day to all of you. So for me, it's really a pleasure to be here, joining Datuk Syed Said Albar, Executive Chairman of the Securities Commission of Malaysia in this session. And actually today we are on the last day of this fantastic week of events under the Sustainable and Inclusive Finance Forum, jointly organized by Bank Negara Malaysia and the World Bank. I really want to thank the organizers for this fantastic event and the World Bank team for the work done. It's very impressive, the agenda, and I'm sure that I have not been able to follow, but I am absolutely convinced that it has been very useful and very productive. I'm excited and privileged to open this event and launch today to launch the report of Malaysia's domestic bond market, a success story. And first of all, I really would like to thank our Malaysian counterparts for the excellent collaboration in the making. And a special congratulations to my dear friends and colleagues, Ana Maria and Sui, but also Agno, Naga, all the team from FCI that has contributed to this report. And that is a fantastic piece and a benchmark for many other countries in the world. They know that actually this topic is at the core of my heart, and therefore, for me, it was really a pleasure when Cecile asked me to be here and to do the opening remarks. I didn't even doubt it. I said that yes, very clear and with capital letters, because I really wanted to be here with all of you today. On behalf of IFC, and I would add of any stakeholder, public and private sector player on capital markets, I really thank you for the work done. So let me start with a basic question, but a question that I think that we always need to ask ourselves when thinking on capital markets development. Why developing capital markets or domestic bond markets is so relevant? Why most countries in the world, emerging markets, are thinking and implementing capital market reforms in the financial policy agendas. I think that there are at least 4 clear factors why capital markets are key and why capital markets are needed. One of them, to support economic growth. I think that is very clear that to provide stable and especially long-term financing, it is critical to have domestic bond markets that can create liquid saving instruments for investors and that can provide the instruments and the tools for issuers that need financing beyond the banking sector. But second, because it serves as a stable source of funding for governments and for the private sector. It's very linked to the previous point, but in a way a little bit different. Because here what I really want to emphasize is that one of the key recommendations that we always make when we do financial sector development analysis or assessments is precisely to have a well-diversified financial sector. A well-diversified financial sector where you have all the instruments and markets that are needed in order to mobilize private capital and in order, at the end of the day, to be able to finance the sustainable development goals in our countries. But also because with the limited fiscal resources, we really need to leverage private sector resources. And the best way to leverage these private sector resources is to create the markets where private sector can go and get financing without intermediaries. The third one, because it is important to strengthen the financial sector resilience. And we have seen many cases and many crises in the past where those countries were very thin and shallow financial sectors suffered the most when a crisis came. Because the financial sector is not well diversified, and because when you have problems on the banking side, you may have a credit crunch, or you may have clear difficulties in continuing financing the real economy. No? Therefore, for the financial sector resilience, development of capital markets is paramount. And four, because it helps to implement the counter-cyclical fiscal policies. So basically related to what I mentioned. Their importance is compounded in times when banks retrench lending due to liquidity needs, as I mentioned before, regulatory uncertainty, or even regulatory changes. So we are seeing banks are less and less pro long-term financing because there are important regulatory reforms that were introduced with Basel III that actually makes banks to or force banks to have a much more match assets and liabilities. And for that, they really need either to use capital markets to get financing long term and therefore be able to lend longer term, or they need to actually reduce the maturity of their assets and their maturities and their liabilities. And if they reduce the assets of the maturity of the assets, then of course borrowers cannot get long-term finance, and therefore they need other sources of funding to get it. So the reality is that many emerging markets continue to struggle to develop deep and efficient local capital markets. So the theory is very clear, the need is super clear, but actually why is it so difficult? Why so many? There are just a few countries that actually got it. A few countries that can't really develop domestic bond markets. So we have done lots of research at the World Bank, and actually the same team that have done this report and other colleagues, trying to find out what are the preconditions, what are the necessary conditions for a healthy and sustainable capital markets. Meaning, does every country, should every country have the aspiration of having a developed domestic bond market? Maybe not, or maybe yes, as long as they satisfy the necessary conditions. And what are these necessary conditions? First of all, to have a stable macroeconomic fundamentals. Second, to have a robust banking system. Third, to have a strong institutional and regulatory framework. Fourth, an efficient market infrastructure. And fifth, or last, to have sufficient size in both availability of long-term capital as well as a robust supply plan. So basically, 5 factors that are not easy, but that actually many countries are in the process of working on these 5 factors to make it a reality. But there is one additional factor that is very important, and I will remark it because probably it's one of the underlying secrets of the success in Malaysia, which is also to have an institutional agreement and political agreement that this is the way to go, that this is absolutely critical, and to align all the institutional and policymakers to achieve this goal. And this is not trivial. It's not a trivial decision, and it's not a trivial issue, because we know that in many countries this becomes a problem. So without these elements, the development of domestic bond markets is very complicated and is very limited. So the Malaysian case, I think that the chairman of the Securities Exchange Commission already made good points on how in Malaysian domestic bond markets have been developing and what has been the success. And I think that the report is also produced with the aim of serving as a blueprint that can be used by other emerging markets and developing economies which are working towards spurring the advancement of their own domestic bond markets. Indeed, Malaysia's development experience offers key valuable lessons for other emerging markets to consider. We know very well that actually there is no one recipe that fits all. We cannot assume that what works in one country exactly the same will work in other countries, but there are good lessons that we can take from one country to the other, and this is one of those benchmark cases that we can use when thinking on or advising other countries to develop their capital markets. The launch of this paper is relevant, and very timely, because we have all the challenges that actually the global pandemic and COVID-19 is creating. Challenges that are making capital markets more and more relevant, if at all. Why? Because we need we have many funding liquidity and rollover risk. We have seen a huge decrease in capital flows internationally, and this makes it even more relevant the need to develop domestic bond markets that can really, in a way, allow a country to absorb and to deal with situations like this huge crisis that we have today. The report distills the elements that supported the development of the domestic bond market in Malaysia, and I think that it is very clear and very good. It's very well explained. However, I'm convinced that having a specific country case that contextualizes these elements will be very useful, as I said before. Now, even if it cannot be applied word by word, it is very useful for other policymakers. Some things that I would like to highlight. One of the key elements highlighted in the report is the fact that building different pillars to form a conducive ecosystem is crucial to support bond market development. The Malaysian experience was a very long journey, as has happened in many other countries, which was anchored on a clear development vision with consistent policies in both the real and the financial sector. And equally important, as I mentioned before, the coordination and the capacity of policymakers and regulators was prominent, and it was absolutely fundamental to leverage and to bring the private sector in. The second, the Malaysia's track record is impressive. The chairman of the Securities Exchange Commission already provided very important and very impactful numbers. No? I mean, now domestic bond market represents 100% of GDP in Malaysia, and more importantly, close to 50% of the bond market are non-government securities. And this is really impressive. That 50% of the market is already corporate or non-government securities is really a big achievement, because we know that this is precisely what we want capital markets to do, not only to finance the sovereign, not only to finance the public finances, but also to provide an alternative way of financing for the private sector, that can really use it as a way of, or that we can use capital markets as a way of putting together the savers and the investors. But it is not only these big numbers. I think that there are other numbers that are also very impressive. Malaysia's, for instance, project bond market also stands out from many markets in its ability to finance the country's infrastructure in local currency. The first project bond in the country was in 1993 and underlined the possibility of mobilizing private sector participation in infrastructure development and even of attracting financing by usually conservative investors such as pension funds. Since then, it has been quite impressive that infrastructure bonds accounted for 26% of overall bond issuance between 1993 and 2019. In the last 10 years, this market has financed an average of 3.4 billion per year in the electricity, gas, and water sectors. And I wish that we had the same situation in other countries, both in the region but also in other regions. No? So as infrastructure development is a prominent post-COVID-19 recovery tool, in a time where government fiscal space will be constrained, this lesson would be even more and more relevant. No? You know that in the World Bank Group, we have this Building Back Better as the third pillar of the approach paper of the response of the World Bank Group to the COVID-19 crisis. And this Building Back Better can actually rely or can actually be implemented much more effectively if using capital markets to finance part of this agenda. In addition, it is important to acknowledge the efforts from Malaysian authorities and regulators in introducing innovations, for instance, Islamic bonds or sukuks as part of the capital market offer. So after this, you would say, okay, so what's next? This country has done everything. This country has a fantastic domestic bond market. So what else can we have in the agenda? Because life is never perfect. We always need new things to do and more things to improve. So the question is, what is next? And I would say here that Malaysia's bond market has been a financial enabler, clearly, for growth and stability, but there are key things that we can still, or some challenges that we still have going forward. First of all, to encourage further diversification and innovation, broadening issuers and investors. In line, actually, with the global themes today, Malaysia has a great opportunity to channel its efforts, and the World Bank Group is ready to continue that. What do I mean? I mean working at least on three different areas. One of them is the Sustainable Development Goals agenda. So sustainable finance, responsible investment. This is a key agenda, and I know that there are great experts that will come in the panel today to talk about this, like my colleague Fiona, that will talk about sustainable finance, that will talk about responsible investment, and that will talk about how to integrate the principles for responsible investment and how to support the integration of ESG activities into investment decisions. Because I really believe that we have to put sustainable finance on the forefront of our agenda. It's absolutely paramount, it's critical, and it's the way to go. And Malaysia has the depth in the capital markets to achieve it. The second is SME finance. This is a key need, a critical need in this country and in many countries in the world. We know that if there is a sector or if there is a type of firms that will suffer the most of this crisis, will be the SMEs. Because they are the most constrained by liquidity, because they are the ones that have less capacity to maneuver this crisis, and we need to provide additional financing facilities and additional ways to get finance to this type of firms. How do we use capital markets? We can use it with fintech, with receivable securitizations, with alternative bond platforms. There are many mechanisms or some instruments out there in other countries that actually Malaysia can also learn from them and allow startups and SMEs to get financing through capital markets and directly with investors. And then the third point, where the World Bank has also a good expertise, is on the development of ETFs, no? Issuer-driven exchange trade funds for government bonds. That I think is a key instrument to provide enough liquidity and transparency to the local currency bond markets, while advancing on the public sector development objectives that any country has. So this will help definitely these three areas to increase the depth and the liquidity of the market, and hence to tackle some of the remaining challenges of this market. Remaining challenges that we could think that are actually common to many other countries, emerging markets and developed countries. One of them is the limited appetite for issues below AA. And we know that there is a problem when we want to go down into the ratings, because we need to change the perception of risk aversion, and for that, or the risk aversion, the risk appetite, and for that we need deep and liquid markets. The second one is precisely related to liquidity, the problems that we may have in terms of trading, so basically lack of trading volume that can actually reduce the capacity or the interest of retail investors in coming into capital markets, and therefore capital markets will be dominated by big institutional investors that will hold to maturity their investments, and this can be a problem. And this is related to the third factor, which is to really democratize, in a way, the use of capital markets by bringing SMEs as issuers and as bringing households as investors. So the stage of development, and I will finish with this last part, I think that the stage of development in the Malaysian bond market presents a great opportunity for the World Bank Group, World Bank and IFC to continue to partner with the authorities in many areas. Further efforts to use the domestic bond market to support the SDGs will surely elevate Malaysia's market to that of its advanced global peers, who have taken great steps to put sustainable finance at the forefront of their agendas. Malaysia has already good pilots, good examples. In the region, we also see many of them. And I would like to finalize with highlighting that this is precisely one of the core agendas of the World Bank Group. Jointly, World Bank and IFC launched the Joint Capital Markets Initiative, which what we try to do is precisely to work through the whole value chain of capital markets, from the policy and regulatory side to the investment side, bringing together the teams from IFC and the World Bank to help countries to develop their capital markets. So thank you very much. And again, congratulations to the team. Ana Maria, Sui, this is a fantastic report. And thank you, Cecile, for the invitation. And I really wish you all the best in this event. Thank you very much.
Thank you very much, Alfonso, and thank you, Datuk Syed, for your remarks, for giving us the perspective of Malaysia and also of the rest of the world. And we are now going to show you on the screen this QR code, which will allow you to download our World Bank report. So you can see that just by this QR code, you can download it, or you can also find it from the World Bank Group Open Knowledge Repository. So I hope that you will be able to do so. Otherwise, it will be available on our website. We are now going to move to the next item of the agenda, and here are two team leaders for this report. It is my pleasure to introduce Ana Maria Aviles, who is a senior financial sector economist at the World Bank, and Sui Ang, who is also a senior financial sector specialist. They are both based in Washington, D.C. So Ana Maria and Sui, please, the floor is yours.
Hi, just testing that everyone can hear me. Selamat pagi to my fellow Malaysians. Good morning as a fellow Malaysian, and a good day to all others who are joining us for the call for this session today. Thank you for taking the time. I know it's not the most convenient for some of you at this time. Firstly, it is by no means an easy feat to follow after Alfonso. I feel he's given pretty much the entire presentation and summarized it very well in his opening remarks. But I think to start off, firstly, I like to quote directly Datuk Syed Zayed Alba, the chairman of Securities Commission, verbatim. Malaysia's progress as a nation certainly owes much to the availability of a well-developed bond market infrastructure and supportive ecosystem of intermediaries, service providers, and investors. He had summarized it very well because for this very reason that the World Bank thought it would be very beneficial to capture Malaysia's journey on domestic bond market development into this report. So it is with this hope that we think that this report and the lessons shared will be very useful to policymakers to think about a more holistic approach to domestic bond market development. But just as importantly, as Alfonso highlighted, we want to emphasize that there is a role for the private sector to play in this development journey. I think Alfonso talked about it as well. That is not a one-size-fits-all approach. Our intention is not to have a cut, copy, and paste approach for policymakers from the Malaysian journey, but really to take away certain key lessons. And again, for every country, there is a different context and a different weightage and a different challenge for each market. But really to look at the way that the Malaysian authorities approach the different pillars to build the ecosystem that we will talk about in greater detail later. So this is just an outline of how we will move forward with the presentation. We'd like to start with the context and scope of this report. This will give you an insight a little bit into the Malaysian bond market in terms of size, but just as importantly, the composition and how it's served the Malaysian economic growth. Secondly, we move into preconditions. Now, often as Alfonso as well had mentioned, in most countries, many of these preconditions for bond market development often lack. And in the case of Malaysia, this illustrates why it's been more successful than many, because it has actually put a lot of emphasis into policies that created the right preconditions for local currency bond market development. Our third section will focus on the drivers of success. This is the meat of the story. We will cover the fundamental pillars to bond market development. And this is where we showcase, in the case of Malaysia, how the authorities approach each pillar to create the necessary ecosystem to support bond market development. At the end, we close with a forward look. We entertain the question of what next for the bond market in Malaysia, given its relatively matured status. So, context and scope. I highlighted earlier why we focused on the Malaysian local bond market as a key lesson for many other authorities and markets. At the end of the day, size is not the be-all and end-all of proven success. Malaysia's story underscores what a bond market is really meant to do, basically address the unmet demand and scarcity for long-term local currency financing, particularly for key sectors of the economy. Just to frame the Malaysian bond market in context, I think there were a few key highlights that I wanted to point out. Number one, the market-friendly policies that has facilitated greater access to the bond market that was really driven by the Securities Commission. There was a strong balance between that and the frameworks for promoting strong disclosure, transparency, and investment protection. The diversity of investment choices, i.e. financing the real sector, particularly sectors that have a strong multiplier effect on the economy. Now let's take a step back. When we talk about the importance of developing a local currency bond market, really is because, number one, deepening the financial market through a well-developed local bond market has many benefits, mainly to mobilize savings and private capital and channel that financing to support financing of the real sector. The bond market acts as a complementary source of long-term financing with the banking sector, and often is even more attractive because of the longer tenors that it affords. Now, very importantly, and more so in the current time, is the importance of financial stability and resilience. I think this has become particularly more relevant in the current macro and financial context, given the impact of the market volatility and shocks in the global markets. As we move on later, we'll showcase that Malaysia has clearly been a little bit more resilient because of its deep local currency bond market to such shocks. So what were the real driving reasons for the Malaysian authorities to develop its domestic bond market? Mainly, it's for the purpose of alleviating currency and maturity mismatches in financing, diversifying credit risks beyond the banking industry, and facilitating the use of high domestic savings to finance the real sector. In essence, if I had to summarize it in 4 key points, and if you look at the left-hand side of the graph, Malaysia had a privatization agenda in the 80s that required access to significant long-term financing, and the bond market was a natural source for that. It was an efficient mechanism to channel the long-term savings that was already present in Malaysia into liquid and attractive investments. Financial stability and reduced concentration risk in the banking sector. And especially for the case of Malaysia and many Southeast Asian countries, it was the hard lessons learned from the Asian financial crisis that really drove authorities and policymakers to a consolidated approach to developing the local currency bond market. Very quickly, this slide basically presents a graphical image of what we had discussed earlier in terms of size and depth. The size of the bond market is close to 100% of GDP, or in absolute value, 356 million in terms of outstanding bonds right now. Composition is a healthy mix, a 50-50 mix between government and non-government securities. And what you see at the bottom left-hand side of the chart is that, yes, while financial institutions and infrastructure represent a large bulk of the non-government securities issuance, you'll still see a relatively well-diversified corporate mix of the different sectors. From here, I'll let my colleague Anna Maria take over to talk a little bit about the preconditions.
Thank you, Sui. So let's talk about the preconditions, what we call an enabling environment. Let's go to the next slide. So when we were discussing the first idea of this report, which we probably like about 2 years ago, I was discussing with her what to present and how to present the story. And of course, she's Malaysian. She worked on the capital market space before joining the bank. And then she got all this very excited, and she was explaining to me that, of course, after joining the bank, looking at all these countries, in Malaysia, there is a nice story to tell. It's not only about the demand or the supply side, is the regulatory framework. It's beyond that. It's about that ecosystem, what she calls, and she will explain that further in the next section. And then this ecosystem is based on an enabling environment that have specific elements that facilitated the development of the Malaysia's domestic bond market. All these elements can be pooled or grouped into 2 buckets. On one side, we have a favorable macroeconomic context and a robust banking sector. And on the other side, we have the government policies that have been consistently oriented to support the development of the Malaysia's domestic bond market in the context of a unified global development mission for Malaysia. If we go to the next slide. So let's start then with the first bucket, the favorable macroeconomic context. So since the mid-1980s, Malaysia started an export-oriented industrialization policy. You can see in the first graph, we have the Malaysia's export mix. Therefore, you can clearly see that this export-oriented industrialization policy was successful, right? There was clearly a change in the composition of the Malaysian exports. See? Okay, thank you. So now with this success, there was, of course, strong growth, a rapid urbanization in the country, an expansion of the formal employment, and overall good performance of the economy as the country was diversifying beyond the primary sector. With this rapid and steady increase, rapid growth, there was also a rapid and steady increase of the household income. And then, as you can see in the second chart, Malaysia's GDP per capita grew from less than 20% of the US level in the 1970s and reached about 40% of the US level at about on the eve of the Asian financial crisis, and it is now above 50% of that of the US level. Yeah, next one. So with this industrialization policy, what we also observe is that the economy was stable. So we have here two graphs. We have the average inflation rates, and then we have the balance of payments and the exchange rates. And what we saw is that over the past 50 years, Malaysia experienced contraction in only 3 years. And all this period of growth was accompanied with cautious fiscal and monetary policies, and therefore you can see in the first graph that inflation had been on average below 3% per year since the 1990s, and the country has also experienced a relatively stable currency since the Asian financial crisis. So at the beginning, I started by saying that we have, yeah, we can go to the next one, thank you. At the beginning, we started saying that we have two buckets, right? One is the stable macro financial environment, and the other one relates more to the government policies. And here we want to highlight 5 key elements, some of which are often overlooked in my opinion in some countries. So the first one is about policy continuity. It was remarkable to see how the vision and the commitment to develop a strong economy and an efficient financial sector was consistent throughout the years, over a long period of time. Then we have consensus. There is political consensus on economic and developmental policies, again, over a long period of time. There is one vision for economic development that is shared across various sectors and industries. And policymakers related to these various sectors and industries. Therefore, then the next element is the coordination among policymakers and regulators, which is kind of the consequence of the two prior elements, right? So if you have a commitment to a development path across sectors and industries, and if you have a consensus and a consistency of policies, then it is easier to coordinate among policymakers and regulators because you are basically looking at kind of at the same goal across the different elements of the economy. Then the next element is the consultation with stakeholders. This again, I think this is one of the elements that are often overlooked in some countries. And it was very, very neat based on my experience in some countries and especially in Malaysia. I experienced firsthand, I've been working in Malaysia over the past 3 years, and is the willingness of regulators to consult with stakeholders and to consider their opinions and to take that into consideration by the time they are designing and implementing the regulation, their policies. So this creates like a virtual feedback loop. Policymakers identify policies, regulations, or guidelines that are more effective once they're implemented, because to some extent there is ownership from the stakeholders that feel they were consulted and they were heard. So I found this a very powerful element. The last but not least, of course, is strong regulators with the appropriate capacity. So at least in the Securities Commission, which is the focus of this report, we saw a strong interest in capacity building and knowledge exchange. So, for example, by the creation of the Securities Commission, there was a knowledge transfer from the central bank. So I learned through working on this report that some staff who were working in Bank Negara Malaysia were assigned or moved to the SC and to be able to kickstart operations in the Securities Commission. Later, we also observed there was a deliberate move by the Securities Commission to hire professionals from the private sector. That means to bring in the market knowledge to the regulator. So I think that was also very valuable lesson. And at the same time, what this SE was doing all this was also looking at more advanced markets and looking for modalities or best practices to bring in that knowledge and to contextualize it and use it for the local context. So with all these elements, the buckets on the macro financial stability and the policies from the side of the government, it is not surprising that Malaysia has always been rated as a low risk sovereign, always an investment grade by Moody's, Fitch, and S&P, with the exception of the year 98, 99 by Fitch. Next, thank you. So in this slide, really what we want to highlight is the importance of the long-term mindset. So with all what we just described, the sustained growth, the stable macro, the policy continuity, the Malaysian savers could be confident that their savings would not be eroded by inflation, by depreciation, or by policy surprises, right? So what you can see in the graph, so is that the Malaysian domestic saving rates increased for about 20% of GDP in the 70s to almost 50% on the eve of the financial crisis. And although there had been some reduction after that, still it's about 30%, which provides a large and a continuous flow of financial resources to the capital markets. Let me also mention here also a very important element in Malaysia, which is the Employee Provident Fund, most commonly known as the EPF. This is very important because it canalizes an important share of the domestic savings through pensions contributions. EPF was created in the 1951, and it has been a key entity in the development of the domestic bond market due to, of course, its preference for long-term investments. And it has grown so significantly that today is one of the largest pension funds in the world. Later, we will talk about in more detail about its importance in this story. So this is kind of the concluding slide of this section. So as you will see during the rest of the presentation, this strong enabling environment really underpins the development of Malaysia's domestic bond market. The combination of a growth and a stable macro, policy continuity and consistency of policies, the capacity of the regulator, all this has given certainty to the market players and allow for the development of a long-term mindset of savers and investors. All these elements facilitated key factors as well. For example, a sound institutional and legal framework, which has created the basics for trust in the market, has created reliable financial reporting, which basically reduces information asymmetries and enhances transparency, supporting a strong credit culture in the market. And last but not least, again, a large and efficient, sound banking sector, which is very relevant because banks have been very important players in the development of the bond markets. As you can see, then overall, Malaysia has enjoyed a positive market sentiment with a long-term focus, which is, again, very, very important, that has supported the development of the domestic bond market since its inception. With this, I give the floor back to Sui. Thank you.
Thank you, Ana Maria. I hope my ability to manage the PowerPoint slides does not reflect my technical ability in the financial sector. So let's move on to the drivers of success. Now, I would say this slide summarizes the Malaysian story pretty much, but also fundamentally reflects the pillars of development for a local currency bond market. But if you look at the flower, as I would call it, and you start from the top and move in a clockwise direction, the policies began by focused on building and preserving these blocks over time. An important thing to note is that more traction with policymakers and investors are often found where financial sector interventions are linked with real sector goals. So right at the core of this flower, as I call it, is that there were clear objectives and a sequence roadmap by the Malaysian authorities anchored in real sector development goals. I talked earlier about the privatization agenda and the goal of the government to create a middle and then high income country over time. This helped to ensure there was a clear vision for the country and that the financial sector would play a prominent role in that. Now, as we move along, as I said, the flower right from the top, at the onset, initiatives were really focused on the preconditions. Anna Maria talked about it, i.e. stable macro conditions, ensuring as well that there was legal architecture in place, i.e. creditors' rights, and that the plumbing of the financial sector, i.e. the financial market infrastructure was in place to ensure there was stability, whether it comes to clearing and settlement of securities. Now, what is often forgotten in most markets is that the capital market is looked in isolation. I think one standout feature for the Malaysian authorities as they approach the capital market, they approach the financial sector as a whole. So often forgotten is that a robust banking system must be in place, where your banks are sufficiently capitalized, that there is a strong regulator as well that is looking at prudential regulations, and that both are meant to be complementary to each other. Anna Maria talked about, as well about capacity of institutions, and they created a foundation of a strong track record and trust in the industry. Now, it is through such institutions like the Securities Commission that they understood the relationship between the needs of the investors and those seeking financing. If you look on the left-hand side of the chart, there is a strong interrelation that must be identified at the onset of what the investors need, but also what the financing needs are from the industry. Basically, the policies were looking at encouraging supply-side conditions, and this included, and I will touch on that later, an efficient government bond market at the onset of market development. I talked about how the capital market development was perceived as part of the broader financial sector development. The Malaysian government developed a policy for its capital market and financial sector encapsulated in three broad master plans. There was CMP1 or Capital Master Plan 1 and 2 that followed, and all that was embedded within the financial sector master plan. Ultimately, the important takeaway from this is a vision, an objective, coordination, and how interventions need to be sequenced in a level that can match with the stage of market maturity and what the priorities are by the authorities. There has to also be a clear leader, of which the MOF was clear leader, which brought together all the various regulators and authorities into a cohesive strategy with clear implementation goals. All this, again, as I mentioned, was anchored on national priorities embedded in the rail sector goals. When we talk about sequencing, just to give you a high-level look at what CMP1 really focused on, it was ensuring the preconditions were in place, but also to liberalize the market. When I talk about preconditions, for example, there were efforts to strengthen the government bond market to ensure that benchmarks were in place and with regularity of issuance. Also, they looked at a more market-friendly issuance framework to make the bond market a more attractive source of financing. Now, as they moved into CMP2, the focus was looking at transforming the market further and embedding growth strategies to further strengthen the structural elements of the market and critical links to foster a more diverse and innovative instruments into the market. Often forgotten in most markets that I work on is that an efficient government debt market is the cornerstone of developing a domestic bond market. At the onset, the government recognized there was a need to develop a proper and systematic program for the development of the government securities market, and this was recognized very early on. I want to highlight that even when the government was recording a budget surplus back in the 60s, they were already issuing government securities to meet the needs of the Employees Pension Fund, or EPF, as I mentioned earlier. However, with time, they integrated their strategies within a more comprehensive bond market development agenda, taking very proactive steps to ensure that the government bond market was efficiently developed. On the right-hand side of the chart, you will see the yield curve development that stretches across a very long maturity. This was very important for the development of long-term bonds, which facilitated infrastructure finance in the market. And this again is often a forgotten component of benchmark building and yield curve formation in most countries. Anna Maria talked about the savings culture. I want to touch on the demand side. And really, one key policy that catalyzed and drove the market was institutionalization of savings. This was through EPF, which was established as early as 1951, which proved to be a very powerful catalyst to pull long-term savings to achieve scale and impact. This was followed by other setting up of statutory funds, such as KWAP or KWAP, as we know in Malaysia, for civil servants that followed. As it stands today, if you look at the total size of the demand side, it is close to $300 billion in today's exchange terms. Given the size of the country of Malaysia, I, in my unbiased opinion, think that is very impressive. And it's through the mobilization and pooling of such long-term capital that Malaysia has really successfully developed its local currency bond market. An important point as well to mention is how are these savings really channeled? At the onset, of course, EPF's assets were channeled mainly to fund the government, but over time, as you can see on the right-hand side of the chart, the asset mix has grown, and this was changed and over time progressively, where it also had an important element of stakeholder consultation and discussion between SC as well as with banks and potential issuers. Now, an interesting element and quite distinct to Malaysia was the policy and the focus of the government on creating key institutions as enablers for the market. A lot of the reforms in the early years focus on the identification and establishment of these key enablers in expediting the market or filling certain gaps. Clearly, the institutional strengths played to the advantage of the market, the well-capacitated Bank Negara and Securities Commission. And it is true, the likes of Securities Commission that should be acknowledged for its proactive stance to make its regulatory functions balance the support of market development and advancement, but also safeguarding market integrity and the continuous emphasis on investor protection. We also can thank Bank Negara for a robust banking sector, which came with a strong credit culture. And the question was, how do you translate that strong credit culture to the bond market? At the inception, I think understanding of credit risks by institutional investors was perhaps a little nascent. So they created the domestic credit rating agencies, and you will get to have one of the panelists from a rating agency later, who's very integral to forming and building further credit culture in the bond market, which allowed proper risk pricing and in terms of bond market. Next, we talk about piloting. I think Alfonso talked about that earlier. What do you do when you don't really have a non-government bond market? So Chagamas was created with a dual function. Firstly, it supported the housing finance market agenda, but it also helped to create a new benchmark. Given its quasi government role, it was seen as a facilitator of a new benchmark building for the market. Now, as the market progressed on the right-hand side of the graph, the authorities didn't clearly just stop and say that's it. They wanted to promote other catalysts that could spur the market further and reduce information asymmetry. You have Dana Jamin, which is a financial guarantee insurer that was meant to promote and support the increase in slightly lower rated credits to come to the market. Bond pricing agency to support pricing discovery and transparency. And the most recent entrant in the market, BIX Malaysia, to reduce information asymmetry by providing a one-stop portal for all bond market information. But I think an important takeaway is that for other markets who are thinking of doing the same, it's not just about creating an institution that can resolve all your problems. There is a lot of thought process that went into the creation of these institutions in terms of the setting up, the governance framework, the risk management framework, and the capacity of these institutions to be able to really deliver on their objectives. Now, one of the biggest challenges for most markets is a viable pipeline of issuers. It was very important that a track record of solid pilot issuers were created at the onset. But for authorities, it was also the right balance of incentives and policies that could create the balance of push and pull factors to attract issuers to the market. Clearly for Malaysia, with the long-term capital, the attractiveness was really in being able to attract, to be able to source long-term funding. And thanks to regulations like on-tap issuance, they were able to go repetitively to the market. And of course, on the push side, banking sector limitations such as concentration limits, etc., really incentivize borrowers to come to the market. Now, there were several catalysts in this that were the piloters, I would say. You had Chagamas, as I mentioned earlier, the privatization agenda, which was largely based on infrastructure finance, saw a proliferation of infrastructure projects coming from the private sector. And very important as well was the transformation of the government-linked companies in Malaysia. There are quite a number of GLCs, as we call it in Malaysia, that have successfully issued in the Malaysian market without government support. Quick pause to look at this beautiful picture. But I think it's important to highlight that very much thanks to the bond market in Malaysia, we have successfully financed a significant number of infrastructure projects, of which a lot are in local currency long-term financing, which most markets struggle to achieve today. I am mindful of time, and I'm sorry that I'm rushing through the last few slides. But fundamentally, I would like to touch on what are the few key ingredients that have helped Malaysia develop a successful project finance bond market. I think on the rail sector side, a lot of thought was given to the concession agreements that was agreed between the private sector and the government, a well-balanced risk-sharing arrangement, which needed more government support at the onset to create confidence, but over time that was slowly reduced. We have a strong private sector who was very reliable and could deliver on projects. And where there was lack of capacity, as Anna Maria highlighted in the earlier part, we leaned a lot on technical experts coming from overseas and back-to-back arrangements with them. And Malaysia, as I talked earlier, had a robust banking sector where we had a lot of expertise in the local financial sector that could structure projects, that could actually put legal documents together, and the domestic credit rating agency also played a big part in their due diligence. Finally, I think one thing that I would like to highlight is that there's not that there was no risk of renegotiation of contracts. This is often one of the key bottlenecks to infra finance in other markets and conservatism by investors. But I think an important takeaway from Malaysia is that there was significant consultation with the market stakeholders, especially bondholders, before any significant renegotiation of contracts took place. Here, I won't go into all the elements of the policy drivers, but I think it's very important again that there was a strong cohesiveness between all the policies that drove the market. I talked earlier about how the supply and demand must meet, and the policies that incentivize both were very well met. And at the core and crux of it, at the end of the day, is a conducive ecosystem and the enabling environment that Anna Maria and I had so much emphasized in all our slides progressively. So, where to from here? Again, there's no market that has no imperfection, even at whatever stage of maturity. I think for Malaysia, there's clearly a need to evolve and develop. I think we talked a little bit earlier about some of the challenges that is the access to the market that could be broadened to some of what we call lower rated credits or smaller companies. Clearly, we have a large institutional investor base, but perhaps the issue is to how do we broaden and diversify that investor base? And like a lot of more matured markets, there are always liquidity challenges. So now we come to what the opportunities are for the market. As I highlighted earlier, there was CMP 1 and 2, and we've come to the end of the Capital Market Master Plan 2. It would be very timely if we could embed and incorporate some of these opportunities into the Capital Market Master Plan 3. We recognize that there's a need to change the current market structure, leverage more on the retail market, and most importantly, embed innovation. I'm very quickly going to end with this slide. I think that Dato' Syed Zaid mentioned very critical elements earlier. I'm just going to repeat it. Diversification, financial and social returns, and efficiencies. I think in those three words, he very much summarized what considerations that the authorities could think about for Malaysia. And I think as Alfonso also mentioned, to initiatives at the World Bank like JCAP, where you recognize there is a meeting place for public sector and private sector, and clearly in the case of Malaysia, there is a strong need for engagement of both sides as they take forward the next Capital Market Master Plan. Thank you.
Thank you so much. Thank you so much, Sui and Ana Maria, for that informative presentation. It sets the scene nicely for our panel discussants. So now we look forward to our discussion with our set of experts who will share thoughts and experience in capital market development. I would like to now hand over the session to Fiona Stewart, who is our lead financial sector specialist in our long-term finance global team in the World Bank Group. Fiona, the floor and the baton is yours. And you might be muted.
I'm double muted. There we go. We thought we'd have got used to this by now, but we're still doing it. I'm delighted to see you all for this evening here in DC. I very much wish I was with you all in KL, but we will be before too long, I have no doubt. We have a great panel here to discuss just such a rich report. It's just so much to talk about, but we have a fantastic panel to raise some of these very key issues that's been brought up by SEC chairman, by Alfonso, and by my colleagues who've worked diligently on the report. We have Mr. Hashim is here with us from the SEC, who is on the front line. He is the supervisor of the capital markets. So the perfect person to talk about this key role of the regulation. We have Dr. Charan, who's with us from the Malaysia Industrial Development Finance. So very much knows about this supply and demand side of things that we've been hearing about so much. Sui Ming is with us, who's one of the queens of the rating agencies in the country, knows this in great depth. So the really important role that they played that we're going to pick up on. And finally, Akamatsu-san, Taka-san, who's one of the gurus of the capital markets in Asia. So it's great to have Taka-san with us. He was formerly with the ADB, but he's really part of the World Bank family. So we're delighted that he's with us today to discuss these issues. So I'm going to start with Mr. Hashim to come back to the SEC. We've heard a very strong message coming through these presentations about the importance of regulation and about the leadership of the SEC. And what I find particularly interesting, two things I find particularly interesting with the story is how you've managed to balance being conservative as a regulator, but with also driving innovation. And that many of the countries we work with, the regulators, obviously when you start a market, you have to be very secure and build this confidence, but you've also managed to be really innovative with new products. And also, interestingly, how Malaysia has developed slightly different from some other markets in that quite a lot of your bonds are still unlisted. They're still in private markets. How did you manage to balance, again, the transparency that you need with the private market? So where did this balance come from, and how did you manage to navigate those development challenges as you went forward, Mr. Hashim? Great to hear from you from the SEC side to start with.
Thank you very much, Fiona. I think, wouldn't be wanting to go back into the reporting. The report itself has been very clearly digested, discussed by our lead writer, both Sui Yi and going to your question about how do we balance between having the right amount of regulation and at the same time also allowing innovation. Maybe if I can just bring into context in terms of our regulatory approach, and in that one that is more cautious to begin with, and the reason for it to be more cautious is to enable let the market get its feet on the ground and so on, and eventually as time goes on, and as you can see more market self-discipline build up throughout the period, then you can ease off some of the regulation. So really the underlying tone of the market development for our bond market is really one that consists of a lot of, if I must say, interventions. Rules can be a bit more prescriptive, very much policy regulatory driven. But that is because we were very conscious that we want to start off the market with a very strong footing. And I think as over the years, I think a couple of points made by Sui Yi and Anna. I think Sui Yi mentioned about the need to have a strong credit culture. I think that is something which we were very much aware of. I think in the market that is new, where we knew at the time the credit culture very much in the banking sector, whereas on the corporate side, institutional investor side is still building. That is something that needs to be developed. And as you can see, one of the things that we have move on is, for example, 2017, we removed the mandatory requirement for rating, for example. That clearly shows how we have progressed, taking into account what has developed in the market. And I think the other aspect which Anna also mentioned is that there is willingness of regulator to consult stakeholders. Yes, I think that is something that needs to happen, because if you are a regulator with a lot of policy in mind that is going to be built to drive the market, and some may lead to intervention. Say, for example, I think we have, for example, a lot of incentives that we have to push. It's not something which you can present to the government and say, this is what I need. But we also need to understand why we need certain incentives to jumpstart the market. And the only way we can able to do this is to understand how the market operates, and nothing beats then consulting regularly with the stakeholders. I think that is of great importance in achieving the understanding at our end and being able to impress upon the policymakers that this is needed for the market to grow. So going back to your question about how do you balance it, in terms of regulations and in terms of innovation, it's actually a very delicate one. I think perhaps during our developmental growth period, I think we were able to somehow manage to get this through. And eventually, has led to a market to continue to innovate. I think talking about innovation, I just move quickly into another segment, which is a fairly successful segment, and which I believe most of the innovation within the fixed income market has come through, which is the Sukuk area. So I think that's also an area where we really had to impress upon not only the government, but also the stakeholders in the market, because I think at the period when the Sukuk was first introduced, there were a lot of concerns regarding, do I need to go into this new space? I might as well, stay with products that I'm familiar with. Why should I add through another cost, and etc. But I think, again, through some of the intervention, incentive, tax neutrality policy, we were able to get issuers coming into the market, investors coming into the market, And also, just to coincide, I think at the time, the government also had this policy on the Malaysia as an international financial center, MRFC. So that has helped grow the market. So I think a bit more intervention from the beginning to make sure that the market is relatively safe and sound, provide incentive to enable innovations. We started off with approval base, followed by disclosure, and today we are launch and launch. So I think there's no formula to it. I think it's all about being able to understand market, having regard and close consultation with your stakeholders, and being able to put this as a important agenda in the within the national policy makers. If I can move on to the the issue of unlisted. Yeah, I think this is not something that is unusual. I think the market in Malaysia is largely OTC. Participation by investors, sophisticated and institutional investors. So I think that also provide reason why we are able to move and liberalize the market quickly. On the issue of the listed, I think sometimes we talk about listing as having many components. I think listing, when we talk about listing, we tend to equate with the equity market where there are trading, there are disclosures, there are compliance, etc. But I think within the bond market, I think to me, the view is that in terms of the trading, I think it's still something which we probably need to see how the market evolve, whether it should be traded on a listed platform or it remains OTC. But I do share that in terms of transparency, I believe in most jurisdictions where bonds are traded over the counter, they are not subject to the same transparency level that you see on the retail equity space. And for us, I think how we look at it is that we think transparency is important, but may not necessarily be in the form of listing. So in the form of more disclosure that is being available. I think one of the initiatives that we have put forward is the bond information exchange to provide transparency for the market. I think Fiona, I may have taken too much time.
We're running a bit behind, but I would love to go. So I think the consultation with the stakeholders I think is key. There's an interesting question. Please post your questions in the chat, by the way. There's an interesting question over here about how you create liquidity in the sukuk markets. You might want to respond to that on the side, but think about that and we'll come back if we have time. But interesting question about how you create liquidity. That's one for you to think about and maybe answer on the side. If you can multitask better than I can, but have a think about that one. But I'm going to move on to Dr. Charan quickly because I think points that you raised, I think it's really interesting how both you managed to create the supply and the demand in Malaysia. I think it's very interesting lessons, I feel, is that how was it, do you think, that one of the things we have a lot of difficulty in getting investors, issuers to really move from banks to the capital markets. How did you really manage to drive that in Malaysia? And then as Sui laid out, the EPF was there on the demand side, but many of the big public pension funds, they're very conservative institutions. They know government bonds. They like to stay with government bonds. How did you really manage to get that kickstart, do you think, of the supply and demand to really get moving in Malaysia? I'd love to dig a little bit more and hear your thoughts on that.
Hi, thank you, Fiona. And thank you, World Bank, for inviting me. Sorry, you can't hear me? Yeah, okay, great. Yeah, and thank you for inviting me. And fantastic panel. And congratulations, Anna Maria and Sui, really amazing report on the bond market. I didn't realize the history. It was worthy of such a magnum opus and such a history. Having been part of the bond market when it first started. Good question about how can we manage to have such a vibrant bond market. I think on the one, and a lot of it comes after the '97 crisis. I think it was a real crisis of confidence for everyone in terms of the financial system as a whole, and reform was needed. So we've heard about the importance of institutions and how the rise of rating agencies and the Securities Commission came up with all kinds of guidelines and things like that. And you're right, we had on the one hand this bedrock of demand for fixed income instruments, which was a pension fund, a national pension fund, the ETF, and that was a good. So we had one hand demand, of course, and we had a supply of high quality instruments. One was called Chagamas, but that's quasi government. But really, the government privatization policy, to my mind, I think that was really the key driver of it. You had high quality debt, high quality instruments being supplied into the market. Now, of course, and you can see actually the maturity and the sophistication of the Malaysian bond market really goes hand in hand together with how government concessions and privatizations have been done. In the very, very early days of privatizations, it was more or less, I mean, it was never explicitly government guaranteed, but it was more or less government guaranteed. The government was going to backstop the concession. And that kind of implicit government guarantee allowed you to issue 10, 20-year bonds. But as everything's got more sophisticated, people know things better. There's less and less of an implicit government guarantee in the structures and bonds these days. But the market has been able to assess the risk for themselves, and so you get a situation where you can raise very long-term money in Malaysia, 10, 15, 20-year bonds, and fairly easily. I mean, it was, at one time to raise 20-year money was seen as a feat. But now it's par for the course that people can raise money that way. So I think that was what kickstarted it. That you had debt which pension funds could safely put into their balance sheet and not feel too concerned about the credit risk. And of course, and things progress from there. So I think that was the way it started. But I'd like to say that everybody knew this at the time we were doing it. I don't think we were had quite so much foresight at the time. It just seemed, oh, this seems a good idea. Let's try this. Let's try that. And it was that kind of, sometimes it was happy accident. Sometimes it was a matter of just, trying to learn and doing things on the fly. But it worked. It worked, and it's quite good to see that we have such a developed bond market these days.
And I think it's interesting that I think there's also lessons from sort of Chile and some of the Latin American markets. You say that it sounds like the instruments were really developed with the thought of the demand in mind when you develop them. What does the pension fund need? Rather than just what do we want to issue, what is necessary? It sounds like that was a very important part of this overall holistic dialogue. Is that right?
Yeah, that's true. I mean, you have to, the banks, banks don't do 20-year. They do 5-year loans or 10-year loans. So yes, we had to find something which would suit an investor. And of course, once you had the rating agencies come in as well, then everyone got a better sense of what you need to, what makes we talk about a loan being bankable, but what makes a project financeable, where you can actually issue long-term debt against it. And allied to that was the development of Islamic finance and sukuk generally. And so you have both traditional, conventional ways of securitizing debt and how you build security and how you collateralize things and how you back and how you credit enhance your issue, as well as Islamic finance principles. And, Islamic finance principles are very suited to long-term instruments. So leasing, lease-based instruments and such forth also help on developing the market. So I think all the confluence of all these things really help the market develop. And of course, regulators were great. They see listening. The regulators were very good and very helpful. And things just worked. But I guess we were also lucky. I mean, there was no one. If in the early days there had been one big default, and then everybody would have lost confidence. But we were fortunate, or whatever it is, markets were up, economy was rising, that there were no big defaults. Now, of course, I think the market can tolerate a default, but at the beginning, we wouldn't have been able to. So that's part of the development. Yeah.
Absolutely, and as you say, that links back to, as Mr. Hugh was saying, the starting with the conservative and gradually moving on the regulatory approach. I think is very important. But Sweet Ming, that follows on very nicely to the role of the rating agencies. And I like this sort of description of moving from an approvals-based to a sort of credit-based, disclosure-based market. It's really interesting that RAM, the very important role, not just of ratings, but the local rating agency, again, is a really interesting part of the story in Malaysia. And in many of the countries we work in, there are the international agencies, but there's also local, which, to be honest, in many markets don't have as good a reputation. How was it that the local nature of the story for RAM and the ratings came about? And then I'm interested in looking forward as well, in that one of the things that was mentioned earlier is one of the things going forward. How do you get to be below the sort of AA, and how do you really grow the depth of the market at the lower ratings? What sort of role does the agencies play in that moving forward as well? So tell us a little bit about your part of the story.
Thanks. Good morning and evening, everybody. It was a real privilege to work on the report, but it's not every day you get the opportunity to, look back at the 30 years or the 40 years of the bond history. RAM itself, we're celebrating a 30th anniversary this year, and when you talked about a local rating agency and how did we actually start out in the market, one of the key points, thanks everybody for validating the fact that credit rating agencies are integral. A few of you had mentioned it, so thank you very much for that validation again. To begin with, I think in the early market, where we have very few players, not everybody knows how to price it. I think rating agencies do have an important role to provide market transparency, ease of access to information. So information asymmetry, not everybody is familiar with the issuer, so it helps build confidence in the market. I think what we see today is that the market has grown to a level of sophistication. When you talk about moving forward, investors are knowledgeable enough, they're savvy enough to make a call whether it needs to be rated, whether or not it's rated, they can price it. So for us, the rating today is independent opinion. So it's something for them to rely on. I think we are also quite happy and proud of the fact that we have a fairly large RAM diaspora in the market community as well, serving in a lot of asset manager companies, in pension funds. So that skill level has also grown in terms of enhancing capacity building in the industry, and that has helped to a large degree.
And we're delighted we've stolen SWE from the ratings yes. community. We've benefited from that as well in our team. And so what about is there an issue, do you think, with this? How do you get beyond the AA? If people have grown used to the agency, you say it's more of an independent third party, but there's still a thought, there's like almost a line in the sand. How do you grow the market below that that level going forward?
I think it is a combination of a lot of factors. I think when we first looked at the market, the single A market was actually very active, right up to the early 2000s. And when we had a significant, some bad defaults that happened, quite a number of rating cliffs that happened, and that probably affected some of market confidence in the single A rated paper. I'm sure, Dr. Charan, you're familiar with that history. So I think it's also a part of what happened after the 2008-2009 crisis with bank prudential guidelines. Everybody is also de-risking. So it's a vicious cycle to some extent, where you have still very good credit quality at the single A, triple B, but because they're not issued, they're not traded, what you see in the market today are grades that have been progressively downgraded. Nobody wants to trade, even though the yield is high, because there's no liquidity. So it's a vicious circle. But that's not to say that they're bad credits. Yeah. In fact, I would say that defaults can be a good thing because it allows the market to do very efficient and effective price discovery and experience through that. Yeah. And when we looked at our portfolio, I think one of the questions, if I can jump into it, was also on the experience of the bond market during the COVID-19 crisis. Now, the market has gone into such a stage that we're a very high quality bond market. Like you mentioned, it's AA and above. So the impact of the COVID crisis, when we first did our impact assessment in April, was that yes, downgrades will be inevitable, but downgrades are going to be very minimal. Even when we stress tested it at the 1997-98 crisis, defaults were less than 2%. The vulnerable credits, a large bulk of it, I think about 40%, were already credit guaranteed by Dana Jamin, right? So that leaves bondholders fully protected. What we see today is in the portion where there is an unrated market, I think that's also a topic that you may want to touch on later, that's grown. And that's where some of the defaults or impaired credits or affected credits, you see some vulnerability there. So that's a question for us also. The role of the rating agency, particularly as you go through a crisis, it becomes even more important to look through where information is coming from, what is the credit position like.
Fascinating. As you said, I think this building this experience, building this deep knowledge of credit markets across the sort of financial infrastructure is very important. I'm going to come back to you if we have time. I'm really interested in credit and the sort of ESG and sustainable finance and how you guys deal with that going forward. That was mentioned as sustainable finance is a growing area. We'll come back to that if we have time. Taka-san, let me ask you to pick up on a couple of things that you have the experience across Asia. How is it you think that Malaysia's managed to, there's a lot of other markets that Thai colleagues, some of the other markets in the region have also done a good job of starting to build their bond markets. But Malaysia's really managed to stay ahead in terms of back to this innovation with the sukuks, with the, with the project bonds. How do you think that's been the case? And then I'd also be interested to ask you to have a little bit look forward as well. We had a couple of questions on the side here, I think interesting about how you build liquidity and how you build a retail market. Two questions coming up, I think, for a forward look. So how has Malaysia stayed ahead and how will you continue to do so with those sorts of challenges? Interesting to hear from you.
Well, thanks very much for inviting me. I'm very pleased that World Bank is doing this event and have done the study, and specifically on the case of Malaysia. Malaysia is definitely a model to look at and follow for many countries, including the countries in the region. And many actually responded to the crisis in 1997. And Thailand, I personally was deeply involved in the crisis management in Thailand and Korea and also Indonesia. Thailand, I think, responded very well to it and made a concerted effort to build the market, and starting with the government bonds, of course. And it was not only the strategy out of their strategy, but also it was out of necessity. And that necessity part was extremely important. But when I went there, one thing that I was told by the local authority was they knew the local currency, long-term bond market is important, but they tried in the past, didn't succeed. Why do you think we could do it this time? That was a question brought to me. My response to them was, in the past, you only wanted to do it. This time, you have no choice but to do it. And that was very much the situation in the country in crisis, which brought all the stakeholders in one table, and led by the Ministry of Finance. And that really kick-started the bond market in Thailand. Now, Malaysia definitely had a big advantage even over Thailand and others. Malaysia was a wealthier country, upper middle income country, even at that time. Thailand was the late stage, the lower middle income country at that time. And between the two groups, I tend to see a clear difference in one aspect. That is, Thailand's non-bank financial institution asset was only 10% of the banking asset. Malaysia already had institutional investor base. And part of the reason is, the big reason, of course, EPF, and which shares similarity with Singapore. But plus the big element behind the success of Malaysia is, I believe, is Chagamas. Chagamas was created in 1986, well before the 97 crisis. And the Chagamas addressed the maturity mismatch stress in the banking system. They not only helped banks to sort of rebuild their balance sheet, but also offered sustainable non-government debt into the market. And this sustainability part is one important thing to keep in mind. The corporate bonds are the instrument of finite maturity, and there are many issuers. If there aren't many issuers continuously issuing, the market actually can disappear. But in Malaysia, it didn't because of Chagamas. Of course, in addition to the government, but the government, all countries try and they can build a sort of core of the debt market. But many others kind of struggle with building a sustainable corporate bond market. But Malaysia very rightly started with the Chagamas, housing finance, and built a core of non-government debt market. And you could also compare this case with Latin America. We often said Latin America was, well, East Asia was very successful, including Southeast Asia, in many aspects of economic development as compared to Latin America. Latin American countries often suffer from low savings propensity and inflationary pressure. The banking system was small as compared to East Asia. East Asia, many countries already had the banking system with the asset worth more than 100% of GDP. Strong banks often means weak corporate bond market. This is across the world. The typical case is Germany, and you can compare that to the US. United States actually had very fragmented banking system in old days, not now, and with state banking restrictions and etc. And sort of a default outcome of that was well-developed corporate bond market in the US. Germany was the opposite, very strong banking system. There was no room for a corporate bond market to grow. But Malaysia addressed the weakness in a banking system and had a pretty strong banking system, but used Chagamas to build the core of non-government debt market. That was a major strategic success in my mind.
Very interesting.
Yeah, I can keep on going. But
I'm going to ask you quickly, just to come back to on one of the questions over here, on that's the supply side. What do you think of the role going forward of retail investors? As you say, the EPF, the non-banks is incredibly important. The non-banks is demand in Malaysia. What role do you see? Because some other markets there's been sort of a bigger retail market. That's been a larger part in some of the other markets around the world. What role do you see for the retail market going forward in Malaysia? Or do you think that's an important next step and next part of the development that could be drawn on?
Well, Malaysia's case, so far the channel for with which the retail investors came in seems pretty clear, which is the unit trust. And generally speaking, there are two channels for retail investors to come in. One is collective investment vehicles, and the other is a direct investment. But generally speaking, for retail investors, individual investors to come into a corporate bond market directly is not easy. And it's not efficient either in many cases. So the collective investment is definitely one way. The retail investors could more easily come into government bonds. Maybe they can participate also in Chagamas market. But corporate bond market by nature is very fragmented because there are many issuers, and even the issues made by one single issuer can be quite different among them. So in this fragmented market, maybe one of the best ways for retail investors to come in is through the collective investment vehicle.
Very good point. I think there's been some interesting work we've done in other countries on mobile selling of directly to government bonds to retail investors, which is a fascinating project in other countries. Can I just come back to you, Mr. Hashim, just to come back to you on the question of liquidity. So as you mentioned, Taka-san, that there's the fragmented markets. Mr. Hajim, how do you think at the SEC? How do you think going forward you can create more liquidity in more secondary markets? Is that something the regulators are working on?
Yes, I think perhaps just let's look at the idea of liquidity in the bond market here. I think sometimes there's a tendency to look at liquidity in as much as what we have been seeing in the equity market. Perhaps, a liquidity in the bond market is suffice to be able to enter, investors to be able to enter and exit the market without having to go through, high friction costs. I think that would probably be the situation for the corporate bond market. And I think as Taka-san has mentioned, I think unlike equity issuances, you would have bond issuances in sizes that range from small to big. So inevitably those in the smaller size, particularly corporate bond issuances. I think in the Malaysian context, for the MGS, I think the liquidity level is far greater than the corporate bond markets. But nevertheless, I think this is also an area where we have been in constant consultation. That is our way of looking at things with the industry. It has been there for a while. It's not something that we can address immediately. It's quite complex. Several other initiatives have been put in place to help provide, say for example, transparency. The idea of for us to keep on diversifying our issuer and investor base, who are able to take a view on the issuances and perhaps willing to take a different position and hence enter into the market. As you know, generally fixed income instruments, if invested by long-term investors, institutional investors, tend to be very suitable for their investment objectives. So I think it's not an easy one.
Yeah.
Ideas that we have, we can look at. One is on market making, as well as, of course, when you have a market makers, there must be incentive. And again, what sort of incentives that can be provided for those who are willing to make market on these bond and sukuk issuances. And the other one, which I think that has been put up, which could probably also help, is having a credit hedging platform. Again, this is whilst it may address the lower credit issuances, but it may also perhaps provide greater transparency and hence interest in the market. There also talks about trading platforms, for liquidity, but I think that's we have to have a closer engagement with our players in the market.
Fiona, if I could just interrupt, I think it's the points that Kidin mentioned and what Taka-san mentioned are perfect points that I wanted to pick up, especially when Kidin, you mentioned, let's start engaging about opening up the market, potentially incentives. And Taka-san, you mentioned about the retail bond market as a potential to grow the market. Is that an opportunity for the Malaysian market? I think from our perspective, it is today, being in a very low interest rate environment and what is foreseeable going to be very low for quite a while, it's a fantastic opportunity for the Malaysian bond market to capitalize on these opportunities, to look at where the retail bond market can help move issuers down the credit curve, new diversified investors coming into the market. I think it's what we've seen when we looked at the data, the growing unrated market. We've also seen a lot of some trading in lots that gives the suggestion that there's some interest in terms of a high net worth individual already participating in this market. Now, if we can democratize this market into a more vibrant, making it easier, more widely accessible for this class of investors to start participating, to bring, again, the mid-cap companies into the market, where we talk about there's a gap, how do you move that rating down the curve? This is again, an opportunity that presents itself, like the market environment is timely for it. So I am glad that you brought that up, Kidin.
There's a question here. I don't know if you want to address. It's a little bit specific, but it's about: is there an institution that can facilitate default recovery scenarios that can help investor confidence below the AA? Maybe it's a bit specific. We can have a think and answer on the side if you like. I'm not quite sure I'm not sure who the question was from there, but if whoever was asking on the default recovery scenario, give us some more details and we'll see if we can answer that.
Maybe I can give you some experience from a rating agency, what happens when an issue goes into default. There are many definitions of default. In Malaysia's case, the experience is that there's been very few actual crystallization of defaults. A lot of them would enter into restructuring agreements rather than an actual default event. I think the last time we've seen it is at the end of last year on one transaction, but that was also a credit-wrapped bond. So most of the time, you will find that the issuers will actively engage with the bondholders through the trustee to already talk about restructuring or rescheduling payment terms directly, either through a refinancing or a reschedulement of payments. Yeah.
Back to this sort of stakeholder communication, I think, is a theme that's running through. We're running out of time. I'm going to finish, but I'm just going to come back to Dr. Charan, because we were talking a bit about sort of the innovation again. And one of my passions is the sustainable finance. And I'm interested, what do you think that there's the role, Malaysia's very much taking the lead on this sort of green finance, sustainable finance. What do you think are some of the sort of new instruments, the new innovations in this area that we could maybe lead on through Malaysian examples?
No, I mean, I think the whole kind of green finance angle is huge here. I mean, my own bank, MIDF, would be at the forefront of this. And one of the speakers at this conference came from the new PNB Tower, which is one of the first green sukuk. But we've also funded other green sukuk. And we think that's a really big idea. So I think that's certainly one way where innovation can happen. The financing, the use of capital markets to finance green projects, however defined. The second one is, I'd like to pick up on this, is the idea of democratization of finance. The capital markets do two things, right? They allocate capital from those who have capital to those who need capital, and they also allocate risk in terms of who should bear the risk and how people should be compensated for the risk they take. Now, on those who need capital, clearly SMEs need capital, and the banking markets may not be doing it well enough. I think we said last time, maybe we should go back to have more single A's and triple B's and go back to the high yield markets. Perhaps we do need a Michael Milken of the Malaysian markets to bring back this idea that the capital markets aren't just only for the big boys, and hopefully that would be able to organize a single A conference with Securities Commission on this. So that's really one thing which is really required. But I'm not sure we should democratize the ownership of bonds. Retail investors aren't very good at handling credit defaults. So a good example were the mini bonds in Hong Kong, where it was very clear to every single person who bought the bonds that you weren't taking the risk on the underlying assets, you were taking a risk on Lehman Brothers. But everyone, of course, didn't acknowledge, just refused to acknowledge this and demanded that they be made whole on the investments. And in the end, the government had to step in. And every time you issue bonds to retail, there's always going to carry this huge risk that the government has to step in somehow to make them whole, because retailers just can't do it. So if you want to sell bonds to retail, I think the way to do it is through, as was said by Mr. Akamatsu, that we have to do it through some collective investment scheme where you can spread the risk and balance on and off. To give you another example is the crowdfunding right now, where people can do peer-to-peer lending. Again, that's meant for retail. But imagine if one or two of these borrowers go spectacularly bankrupt, and lots of retail people lose money. They'll demand it to be made whole. It just will. I mean, that's how retail works. So you can't have credit loss. You can't give credit loss to. So you can solve one part of the democratization problem, which is give SMEs money, we have to solve. But I don't think the other part of it, which is let retail that invest directly in bonds, that I just don't think it works.
Fiona, if I may interject here, since I may have to take a contrary view. Sharon,
panels disagree. This is good.
Because from our perspective, I think it's to a certain extent we talk about the success of the Malaysian bond market, and yet, some of the benefits of the market is not hasn't trickled to the retail. Yes, I acknowledge that you can participate through funds, etc. But I think we should also give access, direct access, bearing in mind there are risks that are associated with investing in bonds, but there are also risks in investing in equity. I just leave it at that.
I'm delighted to finish on a philosophical debate. I should say, Dr. Chan, I was very pleased in your biography to see that you also, like me, did a philosophy degree. So, I'm very glad to finish on a sort of philosophical, existential debate. Very great to have. I would love to continue. I would love to come back to your AA conference. Please hold that conference. I would love to be there. Single A conference. I would love to be there. Delighted to talk to you all of such a rich report, such a rich conversation. More to be followed up with, I hope. Please do follow up with further questions if you have them quickly, but let me hand back to my colleagues in KL, and thank you all very much.
Thank you. Thank you.
Thank you.
Back to Cecile, I think.
Thank you so much. I wish we could have had a half day on this session. It's been extremely rich. This session concludes our Sustainable Finance Forum in Malaysia, and I hope that Firas, our country manager from Malaysia, will agree that it's been an extremely successful event. I want to take this opportunity to thank my team who organized these sessions. Because we've had an opportunity to have discussions that hopefully were useful for our Malaysian participants, but we've had participants from all over the world connect. That's exactly the spirit of this sustainable finance hub, that we are able to, it's a two-way sort of knowledge exchange. We're able to bring knowledge to Malaysia and also really learn from the Malaysian experience. With this, I think we will conclude the session. I might ask Reka to let us know if there is anything else, but other than that, I think we're concluding the session. Reka?
No, this is it. Thank you, everybody from around the globe who's connected today. We really appreciate your time. We will be posting the materials from not just today's session, but from all the sessions this week onto our event website for the Sustainable and Inclusive Finance Forum. So please do connect, and the recordings will be there as well. Thank you so much, and thank you again for participating. Take care.
Thank you all.
Thank you very much all. Bye-bye.